on how the AI revolution is reshaping the macroeconomic balance. AI isn't just some fascinating tech story. You see, by plugging it into the classic ISLM economic model, which basically maps the tug-of-war between product output and the money supply, we can see exactly how this massive productivity shock is going to directly impact global interest rates, investments, and everyday wealth inequality. First, think of AI as a massive economic adrenaline shot. It drastically boosts worker efficiency, making new projects incredibly profitable. So, naturally, every company suddenly wants to borrow cash to invest in AI. This skyrocketing demand pushes economic output way up. But, it also forces the price of borrowing money, the interest rate, to shoot straight up alongside it. Second, this borrowing surge creates a major headache for central banks. Regulators are suddenly staring down a real dilemma here. Are they going to tap the brakes and let interest rates rise to prevent an inflation fire? Or will they open the money spigots to keep the AI party going? They're literally forced to pick their poison. Finally, there's a pretty dangerous wealth gap lurking in the background. If AI productivity absolutely explodes but worker wages stall, well, that new income flows almost entirely to capital owners. And when wages freeze, it outright kills consumer spending. Think about it. If AI does the work and billionaires take the profits, who's actually going to afford the products this new economy creates? Ultimately, AI guarantees a massive surge in economic output. But whether it creates a balanced society or severe wealth inequality depends entirely on the upcoming choices of our central banks and labor market.
We're breaking down the classic ISL model, balancing goods and money, to see why the AI boom will shake up output, rates, and wealth. So think of the overall economy as a massive engine, and ISL is simply the dashboard. The IS dial shows how fast we're producing, while the LM dial tracks the fuel, or money, inside. First, the productivity shock. AI makes worker output skyrocket, so corporate investment absolutely booms. This shifts the IS curve right, shooting economic output way up. Think of AI as a sudden, massive shot of espresso for corporate productivity. But if every business is suddenly rushing to invest in AI, where is all the cash coming from? Well, second, we hit the central bank's dilemma. This massive rush to fund AI spikes money demand, pushing interest rates up. Here, the LM curve kicks in. Central banks must choose: let rates rise to cool inflation, or print money to fuel the boom. Wait. So a massive leap in advanced AI technology could actually be the reason our mortgages get more expensive? Finally, the social divide. AI productivity grows at warp speed, but wages lag. Gains flow to capital owners, widening inequality tracked by the Gini index. If wages stay flat, consumer spending drops. Seriously, if the algorithms do all the work and the tech owners keep all the profits, who is actually going to have the money to buy the products? Ultimately, whether the AI boom ushers in an era of stable, balanced growth or just violently widens the wealth gap depends entirely on how central banks and labor markets react to this unprecedented shock.
Today's sources break down how AI is fundamentally shocking our global economy, changing output, interest rates, and wages. To see the big picture, we first have to look at AI's immediate gold rush effect on businesses. First, the investment boom. Take the IS curve, our goods and investment market. AI creates a massive productivity shock. Workers produce more and capital gets hyper-efficient, making new tech incredibly profitable. It's just like a sudden gold rush. As everyone rushes to invest, output goes up, but that massive demand for cash creates upward pressure on interest rates. Second, the central bank's dilemma. With borrowing costs rising, central banks face a tough call on the LM or money market side. Let rates rise to cool demand and prevent inflation, or print money to keep rates low and fuel the AI boom. It's literally like deciding whether to hit the brakes or the gas on a speeding sports car. Which would you choose? Finally, the inequality gap. Regardless of central bank choices, there's a looming human cost. While AI productivity is skyrocketing, worker wages might rise much slower. Wealth flows primarily to capital owners, worsening inequality, measured by economists using the Gini index. But wait, if regular workers aren't making enough money to actually buy things, won't that eventually weaken overall consumption and drag the whole economy down? Ultimately, the AI revolution guarantees a massive surge in productivity, but it's entirely up to central banks and labor dynamics to determine whether that growth is balanced or deeply unequal. So, the next time you hear about a new AI breakthrough, don't just look at the tech companies. Watch your local central bank, because they're the ones writing the actual rules for our new economy.
We're breaking down how government money printing literally causes inflation, why past economic crises mirror our post-COVID world, and how understanding this dynamic is the only way to protect your purchasing power. First, let's look at the root cause. Back in the 70s, the world faced stagflation, this brutal mix of high inflation and unemployment that standard government spending just couldn't fix. Then, Milton Friedman proved inflation happens when the money supply grows faster than demand. Think of it like a pizza, right? Printing money doesn't make the economic pizza any bigger. It just slices the exact same pie into smaller, way less filling pieces. Well, once economists realized money printing was the fire, they had to figure out how to put it out. Second, we have the painful but necessary cure. In the 80s, leaders like the Fed's Paul Volcker and Ronald Reagan aggressively hiked interest rates to choke off the money supply. Israel even used this exact playbook to crush its own hyperinflation. So, is the severe short-term pain of sky-high interest rates a fair trade for long-term economic survival? For sure. But while we cured the disease back then, it really looks like we threw away the medicine. Finally, that brings us to the post-COVID relapse. Did global governments seriously just forget Friedman's golden rule during the pandemic panic? They printed massive stimulus, sparking brand new inflation. But here's the wild twist. Artificial intelligence, AI, drives massive productivity, which is kind of the only viable way to soak up that excess printed money and stabilize prices without completely crushing the economy. Ultimately, the real question isn't how we fight inflation, but whether we have the discipline to stop causing it in the first place.